There is a peculiar thing about the market that most men never quite accept. It does not move to please you. It does not move to justify your opinion. It moves the way it must, and it leaves a trail, clear as day, for those willing to observe it without argument. Now tell me, have you ever looked at a chart and felt certain it should go up, only to watch it slip lower, step by step? That's not the market being unfair. That's the market telling you something you refuse to hear. You see, the market speaks in structure, not in opinions, not in hope, in structure. And one of the clearest structures it ever gives a man is this lower highs and lower lows. Simple, isn't it? Yet most traders miss it, or worse, they see it and choose to ignore it. Why? Because it disagrees with what they want. Let's take it slowly. A stock rises, pulls back, rises again, but fails to reach the previous high. That is your first warning. Not a loud one, not dramatic, but clear. The next move down breaks the prior low. Now you have confirmation. Lower low. And then it repeats. Again and again. Now ask yourself, what kind of market does that describe? It describes weakness. Not temporary weakness. Structural weakness. The kind that persists because supply is in control. The kind that punishes those who insist on buying simply because the price looks cheaper than before. And that's where most men lose their money. They confuse cheap with opportunity. I learned early that a stock making lower highs is not inviting you in. It's pushing you away. Think about it. If buyers were truly eager, would they accept lower and lower prices? Or would they step in and push the price higher than before? The answer is plain, isn't it? When buyers hesitate and sellers grow more aggressive, the chart begins to step downward. Lower high, lower low. It's a rhythm, a pattern of behavior, not random at all. Now here is where the average trader makes his mistake. He sees the first drop and thinks, it will bounce. He sees the second drop and says, it must bounce now. By the third, he's no longer thinking, he's hoping. And hope in trading is expensive. What he should be doing is observing, waiting, letting the market reveal its character. When a stock forms a lower high, that is not your signal to act blindly. It is your signal to pay attention. When it follows with a lower low, now you have information, now you have evidence. And when the pattern continues, you have something even more valuable. You have a bias. Do you see the shift? You are no longer guessing. You are aligning, and that is the business we are in, not prediction, but alignment. So what do you do with this information? That's the question that matters. Not theory. Not admiration of charts. Action. When you see a clear sequence of lower highs and lower lows, your job is not to fight it. Your job is to respect it. That means you stop thinking like a buyer. You stop trying to catch bottoms. You stop telling yourself stories about value. Instead, you begin to think like a professional. You wait for rallies into weakness. You watch how price behaves as it climbs back toward a previous high and fails again. That failure is your opportunity. Because here's the cause and effect, plain and simple. When price fails to make a higher high, it tells you demand is insufficient. And when demand is insufficient, price must fall until it finds it. That until can be far lower than most expect. Now let me ask you, how many times have you bought a stock simply because it had already fallen? And how many times did it continue falling after you bought it? That is not bad luck. That is you stepping in front of a structure you did not respect. A downtrend does not end because you think it should. It ends when the structure changes. When lower highs turn into higher highs. When lower lows stop printing. Until then, the path is already laid out. And here is where discipline comes in. Not the kind men talk about, but the kind few practice. It is easy to say, I will follow the trend. It is much harder to sit on your hands while the market moves without you. It is harder still to wait for the right rally, the weak rally, the one that confirms the pattern is intact. But that waiting, that patience, that is where money is made, because when you act too early, you are trading your opinion. When you act at the right moment, you are trading the market's behavior. There is a difference, and it shows up in your account. Now consider this. If a stock has made 3 consecutive lower highs and lower lows, what are the odds that the next move is upward? Possible, yes, but probable. The market has already shown you its tendency. Your job is not to argue with probability. Your job is to use it. So you begin to look for entries that align with that structure. Not at the bottom, where uncertainty is highest, but after a failed rally. After the market shows you, once again, that buyers cannot take control. That's where the edge lies. And yet, even with all this, men will still try to outsmart the pattern. They will say, this time is different. They always do. But the market does not reward cleverness. It rewards consistency. Lower highs and lower lows. That is consistency. That is the market repeating itself. And repetition in this business is opportunity. But only if you are willing to see it. Because the truth is, most men don't lose because they lack knowledge. They lose because they lack acceptance. They see the pattern, but they don't accept what it implies. They want the market to turn. They need it to turn. And the market senses that weakness, so it continues its descent, one step at a time, lower high, lower low. And the trader who refuses to listen finds himself holding on to a position that keeps slipping, wondering where he went wrong, when the answer was there all along, written clearly in the only language that matters, price. When price fails to exceed the previous peak, demand is already losing ground. That's not an opinion. It's a fact written plainly on the chart. Yet most traders look straight at it and still ask themselves, maybe this time it will break through. But tell me, if buyers were truly strong, would they hesitate at the very point where strength must be proven? Think about how a healthy market behaves. When demand is in control, price doesn't struggle at old highs. It pushes through them. It doesn't ask for permission. It doesn't stall and drift. It moves with intent. So when you see price rise, approach a previous peak, and then falter, what you are witnessing is not strength gathering. It is strength failing. Now this is where many go wrong. They see price, almost, breaking out and convince themselves that it's close enough. They buy into that hesitation. But the market does not reward, almost. It rewards confirmation. A failure to exceed a prior high is not neutral. It tilts the balance. Because here's the cause and effect. When buyers cannot push price higher than before, it means they are either unwilling or unable to pay more. And when buyers step back, what happens next? Sellers take advantage. Price begins to slip. Not dramatically at first, but enough to tell a careful observer that the tide has turned. You must train yourself to recognize that moment. Not after the decline has already unfolded, but as it begins. The failure itself is the signal. Not the drop that follows, but the inability to rise further. Let me ask you, how often have you entered a trade because price was nearing a breakout, only to watch it reverse? That reversal didn't come out of nowhere. It was born at the very moment price failed to exceed the previous peak. That was your warning. Now, this doesn't mean you act impulsively at every lower high. No, that would be just another form of guessing. What you do instead is observe how the market behaves after that failure. Does it drop quickly? Does it struggle to hold its ground? Does the next rally fall even shorter? This is how a pattern forms. One failure becomes two. Two becomes three. And before long, you are no longer looking at a single event. You are looking at a structure. A clear shift in control from buyers to sellers. And once that structure is visible, your role changes. You stop thinking about what the market could do and start respecting what it is already doing. A trader who understands this does not chase price at the highs. He watches how price behaves at those highs. He waits for weakness to reveal itself, because he knows that the inability to break higher is not hesitation. It is information. And information, when used correctly, becomes an edge. But here is the discipline most fail to develop, accepting that a failed move is often more important than a successful one. Because success can be obvious. Everyone sees a breakout. But failure, that requires attention. That requires patience. When you begin to value these failed attempts, you stop being surprised by reversals. You begin to anticipate them, not by prediction, but by observation. Because the market is not hiding anything from you. It shows you, again and again, where strength exists and where it does not. And when price fails to exceed the previous peak, it is telling you, in the clearest possible way, that demand is no longer in control. Lower lows confirm what lower highs suggest. Sellers are in control. You see, a single lower high might make a man cautious, but it is the lower low that removes doubt. It is the market stepping forward and saying, "This is not hesitation. This is direction." Now ask yourself, how often have you noticed that first sign of weakness, only to ignore it until the breakdown makes it undeniable? A lower high tells you buyers are losing strength, but a lower low proves that sellers are winning. There's a difference between the two, and it's not a small one. One is a warning. The other is confirmation. Think about the sequence. Price rises, but not as high as before. That's your first clue. Then it turns downward and breaks below the previous low. At that moment, something important has happened. The market has accepted lower prices. Not temporarily, not by accident, but by agreement between buyers and sellers. Because that's what price really is, agreement. And when that agreement shifts downward, it tells you everything you need to know about control. Now let me ask you, if buyers were truly in charge, would they allow price to fall below the last low? Would they not defend that level, step in, and push it higher again? The fact that they don't, that they can't, is the clearest evidence you will ever get. And yet, many traders still hesitate. They see the lower low and think, it has already dropped too much. But that thinking comes from emotion, not observation. The market does not care how far it has already moved. It only cares about where pressure is coming from. When sellers are in control, price does not fall because it is overvalued. It falls because supply is overwhelming demand. And until that balance shifts, the path remains downward. This is where understanding cause and effect becomes essential. When a lower low forms, it often triggers something deeper. Stops get hit. Weak holders exit. New sellers step in, encouraged by the breakdown. And what follows? More downward movement. Not because of chance, but because of reaction. So the lower low is not just a signal. It is a catalyst. Now, what should you do with that? That's where most traders lose clarity. They either react too late, chasing the move after it has already extended, or they ignore it completely, hoping for a reversal that has no evidence behind it. The better approach is quieter, more deliberate. You recognize the lower low as confirmation, not as a moment to panic or rush. You step back and observe how the market behaves next. Does it attempt a rally? Does that rally fail to reach the previous high again? If it does, then the pattern strengthens, because now you have alignment. Lower high, followed by lower low, followed by another weak rally. The structure is no longer forming, it is established. And once it is established, your thinking must change. You are no longer asking, will it go up? You are asking, where is the next point of weakness? That shift in thinking separates the reactive trader from the prepared one. A man who understands lower lows does not try to outguess them. He uses them. He lets them guide his decisions, because he knows that confirmation is where probability begins to favor him. But this requires something most men resist. It requires letting go of the need to be early. You see, the lower low often comes after the opportunity has already begun, and many traders hate that. They want to catch the top. They want to be first. But the market does not reward those who are first. It rewards those who are right, and being right often means waiting for confirmation, even if it feels late. Because confirmation reduces uncertainty. It tells you that the market is no longer deciding. It has decided. A downtrend is not a single move, but a repeated failure to rise. That is where most traders misunderstand the market. They see one sharp drop and immediately label it a downtrend. But tell me, can one move define direction? Or is direction revealed through behavior over time? You see, a true downtrend is not about how fast price falls. It is about how consistently it fails to climb. That's the detail most overlook. The market may drop hard once, but what matters more is what happens next. Does it recover and push higher? Or does it attempt to rise and fall short again? That repeated failure is where the real story lies. Think about it this way. If a stock drops sharply and then rallies back above its previous high, what does that tell you? It tells you the drop was temporary. Buyers regained control. But if that same stock rallies and cannot reach its prior peak, something has changed. And when it tries again later and fails once more, Now you are no longer looking at a single event. You are looking at a pattern. Failure to rise once might be dismissed. Failure to rise repeatedly cannot be ignored. Now ask yourself, how many times have you seen a stock fall, then convince yourself the next rally will be the one? And when it fails, you say, maybe the next attempt. That is not analysis. That is hope disguised as patience. The market, however, is very precise in its messaging. Each failed rally is a piece of evidence. Each lower high is a statement. And when those statements begin to stack, they form a narrative that cannot be argued with. A downtrend builds itself through these small, consistent failures. Price tries to rise, fails. Tries again, fails lower. Each time, the ceiling drops. Each time, sellers step in earlier. That's not coincidence. That's pressure. Because here's the cause and effect. When rallies fail, confidence weakens. Buyers who entered earlier begin to question their positions. Some exit. Others hesitate to re-enter. Meanwhile, sellers grow bolder, stepping in sooner, pushing price down before it can gather strength. And so the cycle continues. Now, this is where discipline separates the professional from the crowd. The crowd sees the drop and reacts to it. The professional watches the rally and judges it. Because the rally reveals more than the fall. A weak rally tells you the market lacks strength. A strong rally would break the pattern. But as long as rallies keep failing, the downtrend remains intact. So what should you focus on? Not the size of the drop, but the quality of the bounce. When price rises, watch closely. Does it struggle? Does it stall before reaching the last high? Does it turn back down quietly without resistance? These are not small details. These are signals. Because once you begin to see that the market is failing to rise, you stop expecting it to. And that shift in expectation changes everything. You stop buying dips blindly. You stop looking for bottoms where none exist. You begin to align yourself with what the market is actually doing, not what you wish it would do. And here is something worth remembering. Downtrends often feel slow at first. They don't always collapse dramatically. They grind lower, step by step, lower high, lower low. And because of that, they lure traders into thinking the worst is over. But it is that slow, repeated failure that makes them dangerous. Because every failed rally gives false hope to those who do not understand the pattern. They see the upward move and think strength has returned. But the experienced eye sees something else. It sees weakness dressed as recovery. And that is where opportunity hides. Not in the obvious drop, but in the subtle failure that follows. Cheap prices in a sequence of lower lows are often traps, not opportunities. That's a hard truth for most traders to accept, because it goes against instinct. When something becomes cheaper, the natural reaction is to see value. But tell me, has the market ever cared about what you think is cheap? A stock does not become attractive simply because its price has fallen. It becomes attractive when demand returns. And in a sequence of lower lows, demand is not returning, it is stepping aside. Now think about what a lower low really represents. Price has already dropped, and instead of holding that level, it breaks lower. That means buyers who previously supported the price are no longer willing to defend it. And if they are not stepping in, who is? Sellers. And not just sellers, but increasingly confident sellers. Each new low reinforces their position. It tells them they are right to keep pressing. And as they do, price continues to fall. Not because it is undervalued, but because supply is overwhelming demand. Yet this is exactly where the average trader steps in. He looks at the chart and says, it can't go much lower. But that statement is not based on evidence. It is based on discomfort. He is uncomfortable watching price fall, so he assumes it must soon stop. But the market does not respond to your comfort. It responds to pressure. Let me ask you, how many times have you bought a stock simply because it had dropped significantly, only to watch it drop even further? That is not bad luck. That is you mistaking a declining market for a discounted one. Because here's the cause and effect. When a stock continues to make lower lows, it signals that sellers are still in control. And when sellers are in control, rallies tend to fail, and new lows tend to follow. So buying simply because price is lower places you directly against that control. You are not buying strength. You are buying weakness. And weakness, more often than not, continues. Now, this doesn't mean a stock can never reverse from a low. Of course it can. But the key question is, has it shown any evidence of doing so? Has it stopped making lower lows? Has it broken the sequence of lower highs? If the answer is no, then what exactly are you buying? Hope. And hope, as I've said before, is not a strategy. A disciplined trader does not look for cheap prices. He looks for changing behavior. He waits for the market to prove that the downward pressure has eased. That buyers are stepping in with enough strength to break the pattern. Until that happens, every new low is not an invitation. It is a warning. Now consider how traps are formed. Price falls sharply, then pauses. It may even bounce slightly. This creates the illusion of stability. Traders begin to think this might be the bottom. They step in, encouraged by the lower price. But if the underlying pressure has not changed, what happens next? The price breaks lower again, and those who bought the cheap price are now trapped, holding positions that quickly move against them. Some sell in panic, adding more pressure. Others hold and hope, refusing to accept the mistake. Either way, the market continues its course. That is how traps are built, not through deception, but through misunderstanding. So what should you do instead? You shift your focus. You stop asking, is this cheap? And start asking, is the trend still intact? You observe whether lower lows are still forming, whether rallies are still failing. Because as long as that sequence continues, the probability remains tilted downward. And here is the discipline, waiting for the break in that sequence. Not anticipating it, not guessing it, waiting for it. Because when the pattern finally changes, it will show itself clearly. The market will stop making lower lows. It will begin to hold levels. It may even push higher than before. But until that happens, cheap prices are not opportunities. They are reflections of weakness that has not yet run its course. Strength is proven by higher highs, weakness is exposed by lower highs. That's the rule the market follows whether you agree with it or not. You may hear opinions, forecasts, and confident predictions, but price does not care for any of that. It proves itself through action. And that action leaves behind a simple trail. Now tell me, if a stock is truly strong, why would it stop below its previous peak? Why would it hesitate where it once moved freely? Strength does not hesitate. Strength pushes forward. It breaks through resistance and leaves it behind. So when price rises and fails to exceed a prior high, what you are seeing is not strength building. It is strength lacking. That's the part most traders misunderstand. They see a rising price and assume strength is present. But a rise alone is not enough. The question is, how far does it go? Does it surpass what came before, or does it fall short? Because falling short changes everything. A higher high tells you that buyers are willing to pay more than before. It shows eagerness. It shows confidence. It confirms that demand is not only present but increasing, and when demand increases, price follows. But a lower high tells a different story. It tells you that buyers are no longer willing to push as far, that their confidence has weakened, that sellers are stepping in sooner, cutting the advance short. Now ask yourself, if buyers are stepping back and sellers are stepping forward, which side has the advantage? The answer is already on the chart. And yet, many traders ignore this distinction. They focus on the fact that price is going up in the short term without considering that it is failing in the larger structure. They mistake movement for strength. But movement without progress is not strength. Let's take it a step further. Imagine a stock that makes a strong move upward, then pulls back and rises again, but stops below the previous high. That is your first signal. Now, if the next rally also fails, even lower than the last, what does that tell you? It tells you that weakness is increasing. Because here's the cause and effect. When a stock repeatedly fails to make higher highs, it signals that demand is shrinking. And when demand shrinks, sellers find it easier to push price down. Each failed rally gives them more confidence. Each lower high tightens their control. So the pattern builds. Lower high after lower high. And with each one, the probability of downward continuation grows stronger. Now, what should you do with this information? You observe it. First and foremost, you stop chasing upward moves blindly. Instead, you measure them. You judge them by their ability, or inability, to break previous highs, because that is the test. Not whether price rises, but whether it rises enough. A disciplined trader does not get excited by every upward move. He asks, has the market proven strength? And if the answer is no, if the move results in a lower high, then he adjusts his thinking. He stops looking for buying opportunities in that moment. He becomes cautious. He waits, because he understands that weakness often reveals itself before the decline becomes obvious. And this is where patience becomes valuable. You do not act on the first sign alone. You let the pattern develop. You watch how price behaves after the lower high. Does it break down? Does it form a lower low? If it does, then the picture becomes clear. But it all begins with that failure to make a higher high. That is the market's way of signaling a shift. A quiet shift, perhaps. One that many will ignore. But for the trader who pays attention, it is enough to change his entire approach. Each failed rally strengthens the case for continuation downward. That's how a trend builds its authority, not in one dramatic move, but in repeated proof. The market does not need to convince you all at once. It does it step by step, quietly, through behavior most traders overlook. Now think about what a rally is supposed to do. It is supposed to show strength. It is supposed to regain ground, push higher, and challenge previous highs. That's the purpose of a rally. So when a rally begins and fails to accomplish that, what does it really mean? It means the effort was there, but the result was not. And in trading, effort without result is a warning. Let me ask you, if buyers step in and still cannot push price above where it was before, what does that tell you about their strength? It tells you they are trying, but they are not succeeding. And in the market, trying does not move price. Only success does. So each failed rally is not just a pause in the trend. It is evidence that the trend is still intact. Because here's the cause and effect: when a rally fails, it leaves behind traders who bought into it expecting higher prices. When price turns down again, those traders are now in losing positions. Some will exit quickly, adding to the selling pressure. Others will hold and hope, but their hesitation only delays the inevitable. And what follows? More downward movement. So the failed rally becomes fuel for the next leg down. Now consider how this repeats. Price falls, then rallies. The rally fails. Price falls again, often lower than before. Then another rally begins, perhaps weaker, perhaps shorter, and fails once more. With each cycle, something changes. Confidence in the upside weakens. Sellers grow more aggressive. Buyers become more cautious. And the trend begins to feel heavier, more persistent. That is how continuation is built, not through force, but through repetition. Yet most traders do not see it this way. They treat each rally as a fresh opportunity, disconnected from what came before. They say, this time might be different. But the market is already telling them otherwise. Because if the previous rally failed, and the one before that failed, what reason do you have to believe the next one will succeed? Hope. Hope is not evidence. A disciplined trader looks at the sequence. He sees the pattern of failure, and instead of expecting a reversal, he begins to expect continuation. That expectation changes how he acts. He does not chase the rally. He studies it. He watches how far it goes. He compares it to the previous rally. Is it weaker? Does it stall sooner? Does it struggle near resistance? These details matter, because a weak rally is not an opportunity to buy. It is an opportunity to prepare. Now here is where patience becomes critical. You do not act in the middle of the rally. You wait for it to fail. You let the market show you, once again, that buyers cannot take control. And when that failure appears, you have alignment with the trend. That is where the edge lies. Not in predicting the next move, but in recognizing the pattern that is already unfolding. And understand this clearly. Each failed rally increases probability. Not certainty, but probability. And in trading, probability is enough. Because when the same behavior repeats, the outcome tends to repeat as well. So the trader who pays attention begins to trust the pattern. Not blindly, but with measured confidence. He knows that as long as rallies continue to fail, the path of least resistance remains downward. And he positions himself accordingly. While others are still asking, is this the bottom? He is already focused on where the next failure might occur.